In this presentation, I'm going to step you through the rules of debit and credit. Now, this is a really important part of understanding the formalities of recording transactions, and it's going to really underpin most of what we do for the remainder of this course, and in fact, most of your accounting studies. These are basic principles that allow us to effectively record transactions. We've already looked at that process of what we need to think about when we record transactions. That is, which accounts are affected, how much are they affected by, did they increase or did they decrease? So this is a natural progression from that, where we talk about, now how do we, apart from that table that we looked at previously, which I think we'd all agree is a fairly cumbersome way of recording transactions, and with a larger number of transactions and a larger number of accounts very quickly becomes unmanageable and unworkable. There has to be a better way. Now, I've talked about the accounting cycle before, where we have our source documents. We use the information on those source documents to prepare a general journal. We then post from the general journal to the general ledger, and then we produce a trial balance, and then ultimately financial statements from that. And so these rules of debit and credit really impact on that middle section of that process. That is, recording transactions in the journal, posting to the ledger and producing a trial balance are all hinged upon an understanding of the rules of debit and credit. We've introduced a number of rules and concepts and principles in the course so far, so we're starting to build upon those. Learning accounting and this process of accounting is very much like learning to drive a car. It's about 90% common sense. I hope you'd agree what we've done so far in terms of looking at transactions and their impact is pretty much all about common sense and very little about accounting. And the other 10% is learning some rules. And there's none more important than these rules of debit and credit. It is an area that sometimes creates confusion, because one of the most critical parts of understanding the rules of debit and credit, I suppose, is that we effectively have to unlearn what we already think we know about what those terms mean. We've all been exposed to them in some way, generally from our exposure to our bank statements. We've seen the terms debit, we see the term credit before. We have debit cards, we have credit cards. We have an idea in our heads about what these terms mean, but what we need to do is actually focus on what they actually mean from an accounting point of view. And remember, as I've mentioned previously, the terms debit and credit are simply instructions telling you which side of a ledger account you should be posting a transaction to. Debit means on the left, credit means on the right. They have no other meaning other than that. But our own preconceived ideas about what those terms mean often lead down the path of debit means decrease, credit means increase, because that's how it relates to our bank statements. And so what you have to do is sort of unlearn and forget what you already know about those terms and just focus on what they mean from an accounting sense, which is simply an instruction telling you which side of the ledger we need to post the transaction to. So let's step through this process now so we can figure out how we apply it and work through some examples. The first rule of debit and credit, and it's a fairly important one, and that is that assets are debit in nature. Assets are debit in nature. That means that if an asset exists, the account will have a balance on the debit side or the left-hand side. And if we add more assets to that, if we purchase more assets, then we would record those on the debit side or the left-hand side of the ledger. Right? Very important. And basically all of the rules of debit and credit are built upon this basic premise. Assets are debit in nature, and that, combined with our understanding of the accounting equation, as I'll explain in just a moment, enables us to extrapolate further rules that allow us to apply transactions and record transactions in an appropriate way. So assets are debit in nature. That's the very first thing that we need to know. What else do we need to consider? Well, credits are the opposite of debits. Now, I think intrinsically we probably all understand that concept. If I debit something, something happens. If I were to credit that account, the opposite thing happens. We would probably be able to understand that even from just our own exposure to our bank accounts. But it's an important one because it dictates how we record transactions. So the implications of this concept that credits are the opposite to debits, and vice versa, by the way, debits are the opposite to credits, the implication of that is that if we want to decrease an account, then we record whatever the opposite is of that particular account. So if we've got an account where debits make the balance go up, then if we want the balance to go down, we record a credit. And vice versa, if we have an account where credits make the balance go up, then we record a debit to make the balance go down. The thing about debits and credits is they do different things to different accounts depending on the nature of the account. Some accounts will be increased with a debit entry, some will be decreased with a debit entry. It depends on the nature of the account. And I'll step through that in this presentation so you'll understand exactly which ones apply to what. But it is important. There is no such thing as a negative entry in accounting. We don't record a negative transaction to decrease the balance. We look at the account and we go, this is an account that is debit in nature. If we want to increase it, we put the transaction on the left-hand side. If we want to decrease it, we put it on the right-hand side or the credit side of the ledger account. So it's always a matter of, do we debit it, do we credit it? It's always a positive amount. So here's a simple example. If we've got an asset like cash at bank, an asset is debit in nature, therefore cash at bank would be debit in nature, and therefore increased by recording transactions on the debit or the left-hand side of the ledger. How would I show a decrease in that account? Would I show a negative amount on the debit side, or would I record a positive amount on the credit side? Well, based on just what I just went through, obviously the answer is you would record a positive amount on the credit side or the right-hand side of the ledger account. So let's have a look at how that might look. Here's a simple example. I've got cash at bank. Cash at bank is an asset. Assets are debit in nature. That is, increased with a debit entry, decreased with a credit entry. So let's say, for example, on the 1st of February, I had $5,000 worth of sales. How would I record that? By putting that amount on the left-hand side or the debit side of the ledger account, I'm showing that the asset cash at bank has increased and we now have $5,000 in the bank. What about if I paid some bills? Let's say on the 2nd of February, I paid my rent of $2,000. How do I record that transaction? By recording this transaction on the right-hand side of the ledger account, right here, I'm saying the right-hand side or the credit side, which is the opposite side to the normal side for this account. Remember, it's an asset, they're debit in nature. If I want to decrease it, I do the opposite, which is to record an entry on the credit side or the right-hand side of the ledger. What I'm saying now is I've decreased my cash at bank balance and the bank balance has gone down by $2,000 because I've paid my rent. Obviously, if I've increased $5,000 on this side and decreased $2,000 on this side, then it means I've got $3,000 in the bank. So that's the application, I guess, of this process. If the account is debit in nature, if it's an asset, it's debit in nature. So I record increases on the debit or the left-hand side. I record decreases on the credit or the right-hand side of that ledger account. So let's extrapolate this further. Remember the accounting equation that we've already introduced you to. Assets equals liabilities plus equity. Another rule we need to consider is that whatever we do, our debit and credit balances must equal one another. Everything needs to balance. For every debit entry, there is a corresponding credit entry when we're recording things. Now, if we take those two things together and then add on top of that this new rule that we've just introduced you to, that assets are debit in nature, they have a debit balance, then we can extrapolate from that what the other balances should be in that accounting equation. If assets equals liabilities plus equity, that debits equal credits, and the asset side of that equation is a debit balance, then by definition, the other side of that equation, that is the liability and equity side of that equation, must have credit balances for those first two rules to be true. So you can see this is just an extrapolation of additional rules based on that base premise that assets are debit in nature, and then we've applied that to the accounting equation to figure out what the other side is. So we've now figured out, in terms of our balance sheet accounts, if you like, our assets, our liabilities and our equity accounts, we've now determined what types of accounts each of those are. Now, this is a point where some people are perhaps getting confused because, as I said earlier, we have an understanding of what debit and credit mean from our own experiences, and those experiences typically relate to our bank accounts. A number of you might be thinking, that doesn't make any sense. What you've just explained to me is the opposite of what I understand to be true. You've said assets are debit in nature. Cash at bank is an asset. When we went through that simple example a moment ago, when I wanted to increase cash at bank by that $5,000, I recorded it on the debit side. And when I wanted to decrease my cash at bank account, I recorded it on the credit side. That's the exact opposite of what I experience when I look at my bank account. When I look at my bank account, when money goes into it, it's a credit entry. And when money comes out of it, it's a debit entry. So how do those two things fit together? How can they both be true? Well, the simple answer is they are both true because you need to consider the perspective of the person providing the information. Think about your bank account. The hint's in the title. It's not your statement of your bank account, it's the bank's statement of your account. It's a printed record of what they have in their accounting system. If you put money in your bank account, it's an asset to you, absolutely. But is it an asset to the bank? No, it's not. If you've got money in your bank account, that bank has a liability to give you that money back whenever you want it, whether it be through an ATM, a shopping centre, whatever. And liabilities, as we've just determined, are credit in nature. So what's happening is when you put money in your bank account, the liability that the bank has to give you that money back has increased. And to increase a liability, we record a credit entry. That's why it appears as a credit on your bank statement. Let's think about taking money out. When you take money out of your bank account, you're decreasing the bank's liability. And if a liability is credit in nature, to decrease it, we would do the opposite. That is, debit the account. You've taken money out, the bank now owes you less money. And so to record that decrease in the liability, it appears on your bank statement as a debit entry. So you can see what you see on your bank statement is completely consistent with the rules of debit and credit as I've described them. It's just often we have never considered that a bank statement is actually from the bank's point of view and not from your point of view. Equally, you could think about this in terms of credit card debt. If you owe the bank money, you have a debit balance on your credit card. Now, that doesn't seem to make sense because you have a liability to pay the bank money, and liabilities are not debits, they're credits. How does that fit? Again, it's from the bank's point of view. Sure, when you have a credit card debt, you have a liability, but what is that to the bank? It's an asset to the bank because you owe them money. And assets, as we know, are debit in nature. And that's why when you have an outstanding debt on your credit card, it appears as a debit balance because it's from the bank's point of view and not your point of view. So once you are clear with that, once you realise that it's from the perspective of the bank, then these rules start to make a lot more sense. If it's any consolation, when I first started studying accounting about 1 million years ago, the very opening lecture that I went to involved this discussion around debits and credits. At the time, I worked in a bank, and I thought the lecturer that I was listening to was the biggest fool that I've ever heard in my life. He clearly had no idea about how things worked, and it took me a while to unlearn what I thought I knew about the way bank accounts work and the way debits and credits work in an accounting sense and be able to move on with my studies. So it's important, as I said, to unlearn what you think they mean and perhaps just consider it from the perspective of the bank. You're going to have a much better idea, a much better understanding of how these processes work. All right, so let's continue on with the rules of debit and credit. So there's the correlation, I guess, between debits and credits and that accounting equation. So as I said, the asset side of that equation is debit in nature. Our debits have to equal our credits. And so for those two things to be true, this side of the equation, our liability and equity balances must be credit in nature. All right, that's 3 of the 5 elements. As we know, there are 5 elements that we need to consider. Assets, liabilities, equity, just done. Income and expense. So how do we define those? How do we apply these rules of debit and credit? Well, remember the definitions that we've talked about in terms of income, in terms of expense. How do those things fit together? Firstly, this is just a summary of what we've just talked about. Liabilities and equity are credit in nature. That's what we've just determined. So therefore, they're increased by recording transactions on the right-hand side of the ledger or the credit side. Similarly, if I want to do the opposite, if I want to decrease those accounts, what do? I do the opposite to what I do to increase them. So if they're credit in nature, they're increased by recording transactions on the credit or the right-hand side. If I want to decrease them, I record them on the left or the debit side. Just do the opposite to their normal nature. So getting on with income and expenses. How do they fit into the scheme of things? Well, let's think about the definitions of income and the definition of expense that we've already talked about. We've already talked about the primary definition. The very first thing you look at when you look at what is the definition of income, income exists when there's an increase in equity. in the form of either an increase in assets or decrease in liabilities that's not a contribution by the owner. But let's focus on that first part. Income exists when there's an increase in equity. So if income increases equity, and we've just determined that equity is credit in nature, therefore increased with a credit, what must income have as a balance? So let's think about it again. Income increases equity, credits increase equity. For those two things to be true, income must have a credit balance. So again, these are not additional rules as much as they're just extrapolations of the existing rules we've got, and we're just applying them to the definitions. So therefore, if they're credit in nature, income accounts, credit in nature, increased with a credit, decreased with a debit, the opposite. So those rules are always the same. Once you've established the nature of the account, what is the normal balance of a particular account, then you know what you need to do to it to make it go up, and you know what you need to do to it to make it go down. Income, normal balance is credit. It's credit in nature. So if I want it to go up, I credit the account. If I want to decrease the income account, I do the opposite and debit the account. So what about expenses? Well, think back to the definition of an expense. For an expense to exist, there must be a decrease in equity in the form of either a decrease in assets or an increase in liabilities that's not a distribution to the owner. But the very first part of that definition is expenses decrease equity. Now, if we marry that up with what we now know about equity accounts and the rules of debit and credit that apply to them, what can we come up with? Well, we know that expenses decrease equity. We've already established that equity accounts are credit in nature. That is, they're increased with a credit entry, decreased with a debit. So what happens when we merge those two things together? Expenses decrease equity, debits decrease equity. So for those two things to be true, expenses must be debit in nature. They must have a debit balance. And what that means is expense accounts, if I want to increase them, I increase it with an entry on the debit side or the left-hand side. If I want to decrease an expense account, of course I do the opposite. I put an entry in the credit or the right-hand side of the ledger account. So you can see all of those rules, the application of the rules of debit and credit as they relate to liabilities, equity, income and expense, have all been derived from that fundamental base rule that we started with, which was that all assets are debit in nature. So let's summarise that, just quickly have a look at how these things are affected. So here we've got the three main T accounts for assets, liabilities and equity, the accounting equation if you like. So let's have a look at a summary, I guess, of how these rules are therefore applied. Assets are debit in nature. That is, increased with a debit entry, decreased with a credit entry. The normal balance you'd find in an asset account, of course, though, would be a debit balance. The only time that sometimes changes, this is just by the by, sometimes changes when you have a bank overdraft facility. So if you've got an arrangement with your bank whereby you can overdraw your account from time to time, then the balance obviously in our cash at bank account would switch from being a debit balance to a credit balance because it would move from being an asset to a liability and then back again. So it can actually change its form depending upon whether you're utilising that overdraft facility. But for the most part, you will find assets will have a debit balance in them all the time. Liabilities are credit in nature. That is, we decrease them on the debit side, increase them on the credit side. But the normal balance you'll find on that credit side of the ledger account. And the same applies to our equity accounts. They're credit in nature, therefore debit on the left, decrease, credit on the right to increase, but the normal balance would be a credit balance. What about our income and expense accounts? Let's think about those two again, applying those rules. Remember, we said that expenses were debit in nature because they decrease equity. Debits decrease equity, expenses decrease equity, therefore marry those two together, expenses must be debit in nature. That is, a debit to increase, a credit to decrease, but the normal balance of an expense account will be debit on the debit side of the ledger. And of course the opposite applies to our income accounts. We know that they are credit in nature, that is, credit to increase, debit to decrease. Income increases equity, credits increase equity. You marry those two together, they have to be credit in nature. And the normal balance you would find in an income account would be on that credit or right-hand side of the ledger. I've got another summary here which is more around all of the things we've just talked about. Basically, that's all of those individual tier counts on screen at the moment. There is a correlation, though, of course, as we've just mentioned, between the income accounts and the expense accounts and their impact on equity. So as you can see that link there, that the expense accounts are debit in nature because they decrease equity, which is a debit entry, and the income accounts are credit in nature because they increase equity, which is credit in nature. Another way of looking at it, this is just another summary of the normal account rules and balances that we tend to find. If we have a look through, we've got assets, increases on the debit side, decreases on the opposite, the normal balance is debit. Liabilities and equity are both credit balances. Sometimes you have drawings. We've talked about drawings by the owner, which of course represent a decrease in equity, which would therefore be a debit entry. Income, increasing equity, therefore a credit balance. Expenses, decreasing equity, therefore a debit balance. So hopefully that summary, that walkthrough of the rules of debit and credit is clear, and you now have a better understanding of that process. And what we're going to do in future presentations is look at how we apply these rules when we're recording journals to record the impact of transactions in our business in the financial accounting system that we're operating.